Breaking news, the Federal Reserve just made its boldest move yet. They've slashed interest rates. This isn't just another headline. This decision could ripple through every corner of your life, your mortgage, your job, your retirement, even the way you shop for groceries. So, let me ask you this. What if one policy shift today could either set you up for financial freedom or pull the rug right out from under you? Stick with me, because in the next few minutes, I'll walk you through why the Fed pulled the trigger, what it means for the economy, and most importantly, what you need to do right now to protect and grow your wealth. And trust me, this isn't going to be boring charts and numbers. We're talking about the financial earthquake that could shake America for the next decade. The Federal Reserve doesn't just roll out of bed and say, you know what, let's slash rates today. No, this isn't checkers. It's chess. Every move is calculated, every decision carries weight. When the Fed cuts rates, it's usually because the economy is flashing warning signs, slowing growth, stubborn unemployment, businesses pulling back, or even cracks starting to show in the banking system. These aren't just numbers on a spreadsheet, these are signals of pain that ripple through households, paychecks, and savings accounts across America. Think of a rate cut like a fire hose. The Fed turns on the water to douse the flames of a weakening economy. Cheaper borrowing costs encourage people to buy homes, businesses to expand, and investors to take risks again. It feels like oxygen rushing back into the room. But here's the tension: every fire hose can bring a flood. By cutting rates too aggressively, the Fed may spark a new wave of inflation, higher grocery bills, rising rents, and eroding purchasing power for families already stretched thin. So the real cliffhanger is this: did the Fed just save the economy from burning down, or did they quietly light the fuse for the next financial crisis? Because history shows us one thing: every bold rescue has consequences. Here's where all of this stops being abstract and starts knocking on your front door. When the Fed cuts rates, it's not just a headline, it shows up in your wallet. Suddenly, your credit card bill might feel a little lighter, that auto loan could come with a lower monthly payment, and if you're buying a house, your mortgage rate might shrink just enough to make the dream feel real. Sounds like a win, right? But here's the catch: when money gets cheaper, everyone wants more of it. People borrow more, businesses expand, spending ramps up. And when demand explodes, prices rise. Fast. So yes, your interest payments may shrink, but don't be surprised if your grocery cart starts costing more, your rent creeps higher, or your gas tank eats up the savings. It's like getting a pay raise, only to discover your paycheck doesn't stretch as far as it used to. The number's bigger, but what it buys is smaller. That's not exactly the American dream. Speaking of shrinking paychecks, remember when eggs nearly hit $10 a dozen? Yeah, maybe keep your omelets simple for now. Because the truth is, even small shifts in prices remind us how fragile our balance really is. On Wall Street, there's champagne popping. Rate cuts are like rocket fuel for the markets. Stocks surge, real estate investors line up for new deals, even crypto traders get a sudden rush of optimism. That's why you'll see those flashy headlines: Dow soars on Fed pivot. For the financial elite, cheap money is opportunity. They borrow big, they invest aggressively, and they ride the wave higher. And if you've got a well-padded 401k or a fat brokerage account, you might feel some of that lift too. But here's the hard truth: what's good for Wall Street doesn't always reach Main Street. Because if you're living paycheck to paycheck, working double shifts, or fighting just to keep up with rising rent, soaring stock prices don't put food on the table. The gains stay trapped at the top, while the costs, higher prices, tougher competition for housing, thinner margins, fall hardest on ordinary families. So in one stroke, the Fed has created winners and losers. And that dividing line, the one between investors who cheer every market rally and workers who wonder why their bills keep climbing, has never been sharper, never been more unforgiving. Rate cuts don't just ripple through American households, they send shockwaves across the globe. Remember, the US dollar isn't just our currency. It's the backbone of global trade. The reserve currency nations depend on to buy oil, settle debts, and store their wealth. But here's the danger: when rates fall, the dollar often weakens. And that weakness carries a real price. Imported goods, cars from Japan, electronics from South Korea, clothes from Europe, suddenly cost more. For American families, that shows up as higher price tags at the store. And overseas, something even bigger happens. A weaker dollar makes U.S. assets, stocks, bonds, real estate, less attractive to foreign investors. If money stops flowing into America, the gears of our financial system grind a little slower. Now imagine the world beginning to ask a question we've taken for granted for decades: is the dollar still king? That's not just an economic question, it's a question about American influence, American stability, and American power. Because when the world starts to doubt your currency, it's only a matter of time before they start to doubt your leadership. Now, before we sink too deep into the gloom, let's flip the script. Because history shows us something important, every moment of chaos also opens the door to opportunity. When the Fed cuts rates, borrowing gets cheaper. That's not just a headline, it could be your window. Maybe it's time to refinance that mortgage and lock in a lower payment. Maybe it's the chance to finally launch the business idea that's been sitting in the back of your mind. Or maybe it's the moment to invest strategically, while everyone else is panicking and assets are trading below their real value. Here's the truth: wealth isn't usually built during times of stability. It's built in the transitions, when the world feels uncertain and most people freeze. Those who position themselves before the recovery are the ones who come out ahead. The question is, will you prepare to seize that opportunity, or will you be caught off guard, watching it pass you by? Because make no mistake, the Fed's rate cut isn't the end of the story. It might only be the first move in a much bigger, much riskier game. Right now, America is standing at a crossroads. And in front of us, there are two doors. Door number one, the Fed's gamble works. The rate cuts breathe life back into the economy. Businesses start hiring again, consumers open their wallets, markets stabilize, and the recession everyone feared quietly fades into the background. That's the optimistic path, the soft landing everyone's been praying for. Door number two, the cut backfires. Inflation roars back like a wildfire we thought was already contained. The dollar weakens, foreign investors start to look elsewhere, and, worst of all, the Fed begins to lose its credibility. And if that happens, the same traders and politicians who are cheering today will be the ones panicking tomorrow. So which door will open? That's the trillion-dollar question. And here's the unsettling truth: nobody, not even the Federal Reserve, can give us a clear answer. We won't know for months. All we can do now is prepare, stay alert, and recognize that this moment in history could shape the financial future of every American household. So, how do you play this game when the rules seem to change overnight? How do you protect yourself while everyone else is guessing what comes next? Step 1. Build cash reserves. Cheap borrowing might look attractive, but don't confuse easy money with smart money. A solid emergency fund gives you flexibility and peace of mind. It means you're not forced into risky decisions when the next curveball comes. Step 2. Focus on income-producing assets. This is not the time to chase shiny objects. Instead, look at stocks that pay dividends, real estate that generates rental income, or even side businesses that thrive when money is moving. Assets that put cash in your pocket are what separate survivors from wealth builders. Step 3. Stay informed. The Fed's moves aren't background noise, they're signals. Roadmaps. If you understand what the Fed is doing and why, you'll always be a step ahead of those who are caught off guard. Think of it this way: when the tide rises, you don't want to be clinging to a life raft, you want to be in a boat, steady and ready to sail forward. The people who prepare now won't just weather the storm, they'll use it to move ahead. The Fed just pivoted, and history will judge whether this was the spark of a new boom or the trigger of the next bust. But for you, the choice is clear: react with fear, or prepare with strategy. Now here's what I want you to do: hit that subscribe button so you never miss critical updates like this. Share this video with a friend who needs a wake-up call, because the storm is already here. And in the comments, tell me this: do you think the Fed just saved the economy, or set us up for disaster? I'll be reading every reply. This is more than news. This is your financial future. Stay ready, stay sharp, and I'll see you in the next video.